It is my view that 98% of all traders trade without systems. By lack of systems, I mean that there is an inconsistency in their decision making process in the market. It is also my view that just by having a system in place, we will comfortably beat 98% traders in the country. This will most likely result in us breaking even. When we break even for a long enough period of time, we would accumulate or aggregate significant amount of understanding, which will then be the pedestal for the next success that we might achieve. Once again, survival becomes absolute key in the market, and without a trading plan, success in the market is only a setup for a future catastrophic failure. Keeping this in mind, we have decided to discuss, at least publicly, a very simple trading plan. A trading plan which, in my view, at its current level, will easily be better than 98-99% of the traders. And today, as the market is currently live, and also it is the monthly expiry today, so we will just briefly discuss our trading plan. And it would be great if you check the series of videos that have been created in this sequence of planning a trade strategy, so that you can see the consistency in which we have approached the market, how often we have been traded in the market, and how often did we actually get it wrong in the market, even though our assessments are made a full day in advance. This is not to brag that we are right or wrong. This is simply to say that there is very little room for human error if your plan is documented and you believe there is a justification for having that plan. Let's discuss the core framework of our system. So our system largely relies on just a total of 3 indicators. So once again, I will write these indicators here. There are 3 indicators that we will use in this system. The first indicator is the ADX. The second indicator is the 2050 moving average crossover. And the last indicator is ATR. These 3 indicators have a rule into which when we will deploy our orders in the market. And the rule is simple, that we want the ADX value to be greater than 25. We want a clear golden or a death crossover without ambiguity. And only if the above 2 conditions are met will we use the ATR to determine the SL or the exit from our entry. And how are we going to do that? Our entries are determined by the 2050 crossover. That is the value at which the 2050 moving averages are. And our exit is determined by the last entry, that is the entry at the 50 MA minus the ATR. With this rule, we will carry our trades till as long as our SL is not triggered, because in the previous videos I have addressed that even though we are using intraday time frames to make an assessment on the market, because our market only operates for 6 hours, it becomes extremely difficult for a day trader to first of all catch a pullback and then for that pullback to immediately rally after their entry. Therefore, seeing this chart in continuation, I have outlined our 3 indicators. This is the indicator number 1, this is indicator number 2, this is indicator number 3. And I have outlined the rules of our entry and our exit right here. Keeping this in mind, first step, let's have a look at the ADX. We can see that the ADX is at 28, which is greater than 25, and therefore it is our view that the market is trending strong. Next, we will deploy the MA cross, and we will note that there is a golden crossover in place. Therefore, it is trending bullish strong. If you have seen the previous videos that we have discussed, you would note that our entry would have got traded at approximately 23,550, which is marked by this blue line. And currently the market is pretty close to exactly where we entered on this candlestick, which is of 26th of March at 12:30 p.m. Of course, we are seeing that our 20 period moving average is already open in the market. Therefore, our second entry is going to be at the 50 period moving average, at which point we would have successfully created two lots and averaged our positions. At the moment, we only have one lot. That is the lot that got traded on the 20 period moving average. And the reason why we are placing the order for the 50 period moving average is because at the time of assessment, the market was still trending. Since we have our two entries, which I am marking with the blue line, the next step is to determine the SL. And for that, I will simply include the average true range as an indicator. And here we will see that this value is approximately 75 points. So once again, given that our entry is nearly at 23,400, our SL is going to be at approximately 23,325, which I will mark with the red line. Once we have our clear entries and exits, following is the criteria. If you would have got traded at the candlestick, if you were following our videos in the past, and if we are obviously discussing this as backtesting, we are backtesting it together, and we are simply trying to assess how strong or how weak are trend following systems, and we are doing that on the hourly chart to get a sense of the various types of price actions and chart movements that we are going to see. Rather than doing it on the weekly chart, the structure doesn't change that quickly. So to gain that experience, we are following this as a case study. If you would have traded at 23,550 or 570, then obviously you would remember that at that time we had discussed that the entry would be the 23,000 call. So that is, we would have been long at 23,000 CE. So the spelling of long at 23,000 CE. At that time, we had discussed the stop loss, which you will note that since our SL is now at 325, the SL for that open position will be a minimum 325 points plus whatever is the time value of the contract that you have taken. So if you have taken a weekly expiry or a monthly expiry of the current March series or that of the April or the May series, or is it somewhere in the first week of April, second, third, fourth week of April, these are going to depend from trader to trader, going to depend on the capital that they have to allocate. But you would note how our SL consistently keeps moving upwards, and we are always open to buy at a lower value. Let's have a closer look at the price action today. Yesterday, after trading us into the market continued trading lower. Today, we can see that there is a clear gap down in the market, and this gap down happened in the region of the previous gap. The open sort of became the low, and we can see that after this gap down, the market completely engulfed the previous candle, forming a bullish engulfing candlestick on the hourly time frame in the open. And this becomes a little significant because the zone at which it has formed is obviously the 2050 moving average support zone, and it is going to be support because we have determined it is trending because ADX is above 25. We are obviously seeing gaps, and the previous gap becomes a support zone. The previous trend is on the long side, so we are trading in the direction of significant moving averages. We are not randomly entering, and we are buying the option instead of selling the option because the market is trending, and we have established this in our earlier videos that it is better to write options if your assessment is that the market is in a range in the time frame at which you are trading. So today the market seems to have taken support, and the SL of 325 plus whatever is the time value for the call option would be placed in the market for tomorrow. And logically, we would try to buy the call option at 23,400, which means the entry, that is, if the exit is very clear to us, we know that our second entry is going to be 400 plus whatever is the time value. For the same day, the time value is likely to be similar. So we will see how this particular trade pans out. If now, let's have a look at a slight bit of price action. If the market, which is moving in this direction right now, so I'll mark this in a black line, and obviously this is the direction of the preceding move. This is the direction of the preceding move right here. So this is the uptrend that we are talking about, and it is our hypothesis that this is a pullback. Let us understand what happens if the market makes just the high of today and tomorrow it rallies down. And hits our SL. You will see how beautifully it would have formed a lower top, lower bottom, and on the break of the bullish engulfing, on the break of the gap support, you would have exited your long positions, albeit at a loss. Now, many traders have a concern that after their trade is exited, the market will do something like this. Here I would argue that the market will form a W pattern. And when it does so, it will do this with an ADX value which will be lesser than 25. And when the market becomes lesser than 25, the better trade is not to buy the call option, but to ride the 23,300 put at that time. So, like I said, that if we maintain a consistency in our trading practice, not only can we plan the current trade, but we can also anticipate what our future trades are going to be like. Very often in the industry, faculties, trainers, and other influencers just look at market participation as a single entry exit phenomena. It is my view that trading is far more complicated than that. We will experience streaks of gains and losses, and it is easier to plan for those streaks and our future plan of action in the market, provided we are consistent with our methodology. By using a system-based mechanical setup, we have simply eliminated the role of any discretion. For example, you would note in the video that I discussed a couple of days ago that this level here is obviously a double top and it is obviously a range, but once we use mechanical indicators, we simply do not put any pressure on the eye and we only focus on what the indicators are saying. This choice a trader needs to make well in advance as to how are they going to determine the trend of that particular security. Regardless, we should continue to trade without the fear of hitting a stop loss and only use our stop losses just the way as pugilists use taking a beating as a feedback. So our stop loss, if it gets triggered, is a feedback. If we place the stop loss, a hard stop loss, and it gets triggered, it's a feedback on our good trading behavior. Every time you trade well, even if the trade results in a loss, you are positioning yourself for far greater success than failure in the future. With that, I hope that today's assessment has been useful for you in some way. You may continue to type your comments, feedbacks, and questions that you have. And in the previous video, I think it was Rahul who mentioned that he has short the Sensex call option. I obviously do not know the time frame in which he is trading, but let's assume he's trading the hourly. Then in that case, to short the Sensex call option, assuming the chart is similar to that of Nifty, the justification would be a double top. In other words, the individual is not using ADX as a filter for assessing the trend. In such a case, the individual is exclusively using Dow theory, that is higher top, higher bottom kind of a phenomena. The reason why I do not recommend Dow theory in shorter time frames is because you will always see a higher top, higher bottom, lower top, lower bottom phenomena on such a time frame. It is in the extreme longer time frames where trends are much easily assessed. But there is again nothing wrong in using Dow theory, and if you consistently use this technique, you will also improve in your assessment of this technique and understand better as to where you should challenge the momentum of the market. Regardless, if you have shorted in this particular the call option, which would mean if I were just to directly translate it on Nifty values, since the high is at 23,869, you should ideally be sell on 23,900 call if that is your if that is the plan, if the plan is to trade it as a range. And logically your worst case SL is 23,900, because the only reason why a person would write a call is because they believe that a new high will not be created or a double top will not be created. But if it gets created, you have to book your loss and leave the position. Let's assume you do not book that loss. Then in that case, even if suppose the price action that follows is something like this, and you feel good about not getting panicked and not booking the loss, and let's assume that the price action actually continues in your favor and goes like this. Well, to that I would say good for you for this trade. In general, if you continue with this approach, that is, if the SL is traded and you're not leaving the position and eventually you get into profit, what will happen is that you will hack your system into believing that my SLs are not good enough to exit, and you will not exit them till one day as an option writer you will pay the heaviest price. Therefore, even such a simple method, if not executed with discipline and planning, and if only rewards are searched or seeked rather than the focus on technique, chances are that you could end up positioning yourself very poorly in the market. So with that, I will end this video. Thank you for your time and all the best.